Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Top Credits for Architects, Engineers, and Construction. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters, Shane Hunt, Senior Manager at Moss Adams, MaryCaitlin Willcuts, Manager at Moss Adams, and Kyle Sund, Senior Manager at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Shane to get us started. Shane?
Thanks, Amy. All right, so today, as Amy pointed out, we're going to go through some tax credit opportunities we think that are out there for architects, engineers, and construction companies. I'm going to cover R&D tax credits. MaryCaitlin will cover the retention credits and WOTC credits, and then Kyle will finish up with the 179D energy efficient deductions incentives. So R&D tax credits. The goal of my presentation or discussion today is just to help you guys understand the benefits of obtaining the credit, kind of give you an introduction of what kind of companies can qualify or examples that may trigger if your company may be one that can take advantage of it. Some considerations when claiming the credit outside of the qualifications just to make sure basically that you could utilize the credit. We'll touch on some IRS and state examination hot topics that have been out there recently. And then we'll also review a few recent court cases that have come out that have kind of helped guide our studies so that we're making sure that we're getting the proper documentation to support the studies if it ever does come under examination. And then lastly, we'll just touch on some key takeaways at the end. So the benefits of obtaining the R&D credit. So why should you look into or potentially investigate if your company can take advantage of the credit? And the credit is a dollar for dollar reduction of your tax liability and can generate some pretty significant federal tax savings as well as state tax savings as many states also offer an R&D tax credit that is on top of the federal benefits. The federal credit can help offset any federal income tax savings, where the state credits can offer any tax benefit for state income tax that are due. The credit can be roughly 5 to 10% of the net expenses that are captured. So again, depending on the amount of expenses you're spending that can qualify, can lead to a pretty significant credit. Examples of studies that we've done for different types of either contractors or engineering or architectural firms. And I throw this slide out here just because a lot of times I get a question about, we're a $50 million revenue company, we're a $100 million revenue company. What do you think, our credit potential is? And the trick is the credit isn't based on any kind of revenue or income. It's based on costs or expenditures. So, you can be a large company, but if your R&D expenses are small, you may not be generating as large of a credit as potentially a smaller revenue company that is putting more dollars into R&D eligible activities. So, for example, we see a $40 million, concrete contractor got a $300,000 R&D credit, where a $150 million engineering firm, got a $150,000 R&D credit. So the credit itself isn't tied to revenue or the size of a company. It's more based on, the activities you're performing and where you're spending your dollars that will generate the credit. Another thing that we like to point out is it can offer a competitive advantage in that the more money that you're keeping in your pocket and not paying in taxes is positive cash flow for the company that you can either reinvest or distribute how you see fit. And it also helps to offset, the projects that we typically see qualify can be the riskier ones, the ones that are potentially, more innovative, pushing the limits on what you guys do. And so that additional risk is what the credit is kind of there for, is that the government wants to kind of reward you, I guess, for potentially taking on the more challenging and risky projects. And so it can help, the credit itself can help offset, kind of that risk element to it. So what are some examples, or how would you know if your company could potentially qualify? And the next few slides are going to give a bunch of bullet points on different things that we look for, depending on the company. We'll say that it's not industry specific, as far as certain industries can claim the credit and certain industries can, particularly with the federal credit. Some states may have different rules as far as that goes, but you don't have to be wearing lab coats or anything in order to be able to claim the R&D credit. Things we look for, or things that may trigger, hey, there's potential for my company to take advantage of this, is if you do, from a construction standpoint, if you're involved in design build work where you're responsible for the engineering and design piece, if you're going through when you're doing your designs or engineering efforts, if there's prototyping, modeling, that systematic trial and error testing taking place, you're going through and significantly making changes or improving the processes and quality or performance of how you guys are performing your work, because the credit can be related to both product development or process development. Either one of those are eligible. And then another trigger is if your company has ever claimed any patents. That's a good sign that there's probably some R&D expenses out there that could be used to generate a credit. Specific to construction, a lot of times what we look for is, if you're developing any unique or energy efficient features, civil projects, water treatment plants, roadways, bridges, having to develop or design any of those types of structures. You get into your geotechnical with your foundations and earthwork, developing any new means or methods for the construction piece is, again, that process development. Components of a project. So, the entire project doesn't have to be qualified. What we can do is look at certain aspects or components of a project and narrow down our focus onto those. And if those meet the criteria, we can capture the expenses related to just those specific elements of the project and claim those as an R&D expense. We see that in like mechanical or electrical systems oftentimes. And then something that people may not think of a lot is kind of those temporary systems that you guys potentially have to develop in order to just perform the work. Whether it's the false work, form work, dewatering systems, things along those lines that are just temporary. And once the project's over, you're going to remove those. But if there's a development effort, an engineering effort, a design effort, and how to come up with the right systems related to that, then there's potential there that those types of activities can qualify. Looking at something more specific to architects and engineers, anytime that you're coming up with something new or innovative, kind of pushing the boundaries, or maybe the owners are asking you to design using systems that you may not have worked with before, or aren't kind of standard systems that you're having to spend kind of time, money, resources figuring out what it's going to take to implement those types of systems. Again, it's analyzing soil subterranean conditions, whether it's for construction project or something along those lines. If you do get involved in the design of buildings, again, you're doing the electrical, lighting, HVAC, building envelope systems. A lot of times that's where we see potential for qualified expenses. So how, if you're performing those types of activities, kind of the next level of detail we need to get into is there's basically 4 criteria. The IRS calls it their 4-part test that an activity needs to meet to be eligible. There has to be some technical uncertainty in what you're trying to perform. That processes of experimentation, whether it's computer modeling, computer simulations, actually physically building mock-ups or prototypes, or a systematic trial and error process would satisfy that process of experimentation criteria. Technological in nature, meaning there has to be a hard science behind what you're trying to do, which is why a lot of times we focus on that engineering piece is in hard science. But if we're also, doing any of the testing that involves, physics, chemistry, geotechnical sciences, things along those lines would satisfy that 3rd test as well. What types of expenses can we capture as R&D expenses? One is wages. So the people that are performing the R&D work, we can capture a percentage potentially, or sometimes their entire wage, depending on how involved in the process development they are. Material costs, if you are building mock-ups or prototypes that are strictly for testing purposes, any material or supplies that go into that are ultimately scrapped can be eligible R&D expenses. And then contract research. So if you're using any third-party subcontractors to help develop or install or build the R&D activity, we can capture some of those expenses as long as you're the one directly, paying for that contract research. It's not an owner paying for it. Again, assuming there's no limitations that all this can add up to, you take all these R&D expenses, add them up, and roughly, you're probably going to get somewhere between 5 and 10% of a dollar for dollar credit based on those expenses. So it looks like we've got a polling question.
All right. So our first polling question is, does your company currently claim the R&D tax credit? And your options are A, yes, B, no, C, I don't know, or D, NA. And we'll give you a few moments to respond. Please click the button next to the answer you choose and hit submit. And as a reminder, if you would like to receive CPE for today's webcast, you will need to respond to at least 3 of the 4 polling questions. We'll leave it up another 5 seconds or so. Okay, here are the results.
All right, so somewhat, even across as far as some do and some don't, and a few aren't sure. But that's kind of what I would say, I guess, is, if you're not taking advantage of it at this point, it's definitely something to potentially look into here in the future and see if it's something you're eligible for. All right, so consideration. So, outside of an activity and the expenses we've identified, you still want to be sure that you can take advantage of the credit, because you can generate a credit, but there may be items that could keep you from being able to utilize it. So one, the credit can only be used to offset taxable income generated by the entity that's generating the credit. So you want to make sure that there's taxable income to offset, or tax to offset. There is a limitation. AMT is not as big a factor with the changes in the tax laws recently, but it can be. We can potentially only take you down to that minimum tax threshold. And then there is a 25-25 rule, basically limiting the credit. You can only take you down to 25% of any tax due over $25,000. If for some reason you generate a credit that you can't use in that current tax year, you don't lose it. One, you can carry it back to a prior year, 1 year, and then if you can't use it there, you can carry it forward for 20 years. And some states have different rules as far as that goes, but it's pretty similar. Another thing that impacts the ability to claim the credit is contracts, or funded research is what they call it. So anytime you're performing work under a contract for another person, you have to have rights to the work you're performing, meaning you can do similar type or utilize the R&D knowledge in the future on other projects. And then you have to have some risk, meaning there's potential that you may not, if you don't complete the R&D successfully, you may not get paid for the work. So we see, it's not work performed under lump sum, fixed price type contracts, typically meet that threshold, where any work performed under a T&M or cost plus type contract may not meet that threshold. And then lastly, if you're doing R&D, but any of the R&D efforts are performed outside of the United States, it cannot be included as part of the R&D expenses. Since it's a U.S. tax credit, they want the work to be staying in the country. So IRS and state exams. So some of the common areas of focus we've seen recently in exams is they really want to see that connection between projects and the expenses being claimed. And the documentation is key to that, and showing what did that process of experimentation look like? What were you guys doing from a computer modeling or mock-ups, prototypes, or what did that trial and error process look like? And being able to tie also who is involved in those efforts. If we're claiming wages of people, we need to kind of be able to show what these people's activities were and how they contributed to the development. And then again, the contracts piece, that they want to see that your company has both risk and rights related to these development efforts. There's been a few recent court cases that have come out regarding the R&D tax credit. One back in 2019 was a Siemer milling, wheat flour milling company, claimed R&D credits, but the IRS denied the credits, and so it went to court. And the court found that they didn't have the documentation necessary that really showed, the experimentation piece and what they were trying to test and how they were testing it. And so they couldn't tie the activities back to the expenses, at least not enough for the court to accept. And so they did wind up disallowing the Siemer Milling's credit. One, I guess, good thing that came out of the court's decision was the IRS tried to argue that only employees with specialized degrees could be performing R&D activities, where the court said, no, that's not the case. You don't have to have a PhD or some high profile specialized degree to be doing R&D. So that's something that came out taxpayer friendly from that decision. The Little Sandy Coal Company versus Commissioner. So Little Sandy was a boat building company, claimed R&D credits related to 11 projects. The IRS, again, rejected the credit, saying they didn't have evidence to prove that they met that substantially all rule when talking about that experimentation efforts that they engaged in. Again, the documentation of that process of experimentation is becoming more and more important as these court cases have come out, and really being able to tie the activities and the people involved together, and then also being able to tie the expenses related to those efforts. Again, the court found that they didn't have that documentation in place, so they rejected the credits. And at the end, they also were looking at the prior court's opinions, and the current court rejected some of the prior court's opinions, and so we'll have to see going forward, how that plays out. And then the last one I want to touch on, Populous Holdings. They're an architecture firm that claimed R&D credits. Again, the IRS denied them based on the contract, so with the funded research issues. The tax court in this case examined the contracts between Populous and the third parties that hired them, and they found that the contracts did meet the financial risk and sufficient rights requirements, and were able to retain the credit. So one, it gave us some support on what to look for in contracts, but two, I think a key point here is the IRS didn't try to deny the credit based on the activities of the architecture firm. They strictly tried to deny it based on the contracts and the terms within those contracts, which kind of gave us, a boost in the architecture firms and the activities that they perform can be eligible, and makes the company able to take advantage of the credit. So before we move on, just a quick review here. Kind of walk through some of the benefits of claiming the credit, the types of activities and expenses that we typically see can be included. Outside of those, criteria that you need to meet, there are some other considerations for usability purposes when you're claiming the credit. And then lastly, just touched on, what the IRS is typically these days, kind of the hot topics they're looking for, and some of the court cases that are guiding their decisions. So, with that, I think I will turn it over to MaryCaitlin. Thank you.
Great, thank you. All right, now we're going to kind of transition and discuss the employee retention tax credit. So the employee retention tax credit, it originally passed into law under the CARES Act back in March of 2020, and allowed this program for basically the remainder of 2020. The credit was created as an incentive to employers who were hit by impacts of COVID-19, and to retain and pay employees instead of releasing them, and then they subsequently are going on government assistance because they have lost their job. In December of 2020, the Consolidated Appropriations Act was signed into law that included a 6-month extension of the credit through June 30th. And in addition to that, it also expanded on the qualification criteria to make it more favorable to employers. And then further, the recent American Rescue Plan Act was signed into law that added another 6-month extension to what the Appropriations Act had passed, and also added a couple new opportunities for businesses that were really severely impacted by COVID-19. So to determine who is an eligible employer for this program, we've kind of created a breakdown between the 2020 provisions from the CARES Act and then 2021, when the CAA, the Appropriations Act, extended and expanded the qualifications. So for 2020, an eligible employer is one who meets one of the following options. So these are an or, it's one or the other. So first, if an employer experienced a full or partial suspension of operations due to a government order limiting commerce, travel, or group meetings. This is really more applicable to non-essential employers or non-essential portions of an employer's business that, essentially could not be performed remotely, so the business wasn't able to pivot and have, their operations continue in a remote setting. And so subsequently they had to shut down or severely limit the operations because of these orders. So the IRS recently came out with a new notice that further expands on, kind of the guidelines of the program and how employers can, more specifically determine if they do in fact meet these qualifications. Because when you talk about, full or partial suspension of operations and government orders, it can get really confusing. It's not a black and white situation. It's circumstantial, business by business. There's a lot of different factors that go into it. But one thing that the IRS has clarified that's been very unknown for the majority of 2020 is this term that they were using, where the portion of the business operations that had to be fully or partially shut down needed to be a more than nominal portion of the business's operations. And what more than nominal was supposed to mean is what was unknown. And so the IRS recently provided guidance on that and essentially said that, a more than nominal portion can be measured by looking at, and this is based on 2019. So in the normal course of business in 2019, in the same quarter when the business is experiencing this shutdown, if the portion of the business that shut down makes up at least 10% of the entire business operations, and that's measured either looking at the gross receipts or employee hours. So the other way a business can qualify if the full or partial suspension does not apply is based on a gross receipts test. So for 2020, in a calendar quarter compared to the same quarter in 2019, if there's the first quarter in which a business experiences a more than 50% reduction in gross receipts when you're comparing the 2020 versus 2019 quarter. After the first quarter, when the gross receipts reduction has been met, the business then stays qualified until there is a 2020 or even into 2021, a quarter where the gross receipts finally reach back to at least 80% of the same the same 2019 quarter's gross receipts. So basically, until the business has, at least a 20% or less reduction in gross receipts. But something that's important to note here is, depending on the ownership structure of the business, there are aggregation rules that may apply that would require the business to aggregate their gross receipts with other commonly owned businesses to determine if that 50% reduction has occurred. So something important to note there. Comparatively for 2021, similar rules apply, and so the full or partial suspension still applies. Nothing has changed there. But for the gross receipts test for 2021, the business only needs to show at least a 20% reduction. So when you're comparing a 2021 quarter, you're continuing to compare it to 2019. So they're having you compare it to a year when your business was kind of going through its normal, business operations, no severe impacts due to COVID. And as long as you can show a 20% reduction in gross receipts, that would qualify the business for 2021 quarters. There's also an alternative option for measuring the gross receipts that's exclusive to 2021. And this option allows employers to determine if they meet the 20% reduction by alternatively measuring the gross receipts from the immediately preceding quarter. So for example, if your Q1 21 versus Q1 19 gross receipts do not show a 20% reduction, then you can alternatively measure Q4 of 20 versus Q4 of 19. And if there's a 20% reduction there, then that would automatically qualify the business for Q1 21. And so that same rule kind of applies as you go through the quarters in 2021. So now that we've kind of discussed, how an employer may qualify, the next thing is to determine if the employer has qualified employees. So during 2020, an employer who had 100 or fewer full-time employees based on their 2019 average count, they were considered a small employer, and therefore all wages and qualified health plan expenses paid to employees during the time that the employer is qualified, that all might be used for the credit calculation. However, employers who had more than 100 full-time employees in 2019, they're considered a large employer, and only the wages or health plan expenses paid to employees while they could not provide any services at all are qualified. One of the most common areas of qualification in this category is furloughed employees who the employer continued to provide health plan benefits during their period of furlough. Full-time employees, they're based on the average number of employees in 2019 who worked at least 130 hours a month. So the measurement for the full-time employees is a little bit different than your traditional FTE full-time employee test. Additionally, depending on the ownership structure for employers subject to the aggregation rules, you do have to take into account the full-time headcount aggregated across all commonly owned businesses to determine if they're over or under that 100 employee threshold. Going into 2021, that 100 employee threshold increased and became 500. So for 2021, really expands the opportunity for businesses who had 500 or fewer full-time employees in 19, because then, all wages and health plan expenses paid for those employees during the time they're qualified can be used for the credit calculation. So once an employer has determined that they have qualified wages, you can kind of look at what the credit opportunity is for your employees. So for 2020, it's a 50% credit on up to $10,000 per employee for all qualified quarters, resulting in a maximum $5,000 credit per employee. For 2021, the credit increases to 70% on up to $10,000 per employee per quarter. So this results in a maximum $7,000 credit per employee per quarter, or $28,000 for all qualified quarters in 2021. So to claim the credit, it's a fully refundable credit, and it's a payroll tax credit. So for an employer to claim the credit, there's 3 different ways that they can go about it, depending on the timing and of when you're trying to file the refund claim. So if you're in the current time, so let's say we're looking at Q2 of 2021 and you're qualified, you'd be able to claim the credit on your original 941. There is the option for employers who have 500 or less full-time employees in 2019 that they are allowed to file a Form 7200, which is a advancement request of the credit. And essentially this form allows employers to file this throughout the current quarter to request an advance of the credit that they are generating as they're paying wages throughout the quarter. And then at the end of the quarter on their 941, they would reconcile what they've claimed with the 7200 throughout the quarter. 7200 is entirely optional. It's not required. It's just an option for employers who want to try to speed up the process of getting, their refunds. For retroactive opportunities, employers can amend their 941 with a Form 941X to request a refund of the credit that they generated. And since, all the employment taxes have already been paid in 2020, you'd be able to get a full refund of the credit that you've generated, either as a physical check from the IRS, or there's an option to apply the credit towards a current quarter tax liability. The 941X, the statute of limitations to amend essentially is 3 years from the date that the original return was filed, or 2 years from the date that the taxes were paid. So there is time to amend if available. So the ARPA, that was recently passed, it did provide a couple new ways employers may qualify for the third and fourth quarters. So this is completely new and different, and these are for severely impacted businesses. So the first one is the recovery startup business. This is limited to a $50,000 refund per quarter for businesses who started operating by February 15th of 2020 and have annual gross receipts of less than or equal to $1 million. And then the second one, although it says funded research, it's actually severely financially distressed employers. This is any size business, so that full-time headcount doesn't apply. This is any size business with a more than 90% reduction in gross receipts compared to the same 2019 quarter. They're allowed to generate a credit on all wages paid to employees during that quarter. So again, that 500 or less headcount does not apply in this situation. For PPP recipients, initially the CARES Act had a limitation on any business or business that has to be aggregated. If any commonly owned business took a PPP loan, it automatically disallowed the retention credit for any of those businesses. The Consolidated Appropriations Act, when it was passed in December, retroactively removed that limitation and now allows businesses who took a PPP loan to go back and amend their payroll tax returns to claim the retention credit during qualified quarters to the extent that they have excess wages paid to employees that were not included in the forgiveness. So big point here, you cannot use PPP forgiven wages to also calculate the employer retention credit. This is also something to be mindful of as you, in 2021, for any businesses taking round 2 PPP loans, you also qualify for the retention credit and you want to apply for forgiveness for your loan, keeping in mind the minimum amount you need to have for wages for that forgiveness so that you can take both credits, you just want to make sure that you don't take the retention credit on any wages you might need for that forgiveness. In addition to the limitation on forgiveness wages, for 2020, the CARES Act limited the wages if that were used for work opportunity tax credit, the paid sick and family leave credit that was under the FFCRA, the Families First Coronavirus Response Act, as well as a separate federal program for paid family and medical leave credits. Then for 2021, the Appropriations Act further limited wages paid from the R&D credit, and then the ARPE has now, for the third and fourth quarters, added that any wages paid from certain grants under the SBA or even under the new restaurant revitalization grant, any of those wages cannot be also used for the retention credit. Amy, so it looks like we've reached our next polling question.
All right, thank you. So our second polling question is, did your company suffer a partial suspension of operations due to a government order or have a reduction in gross receipts? A, yes, a partial suspension. B, yes, a gross receipts reduction. C, none of the above. D, not sure. Or E and A. And also, I just want to let you know that we are receiving several questions from the audience, and in order to make sure that we get to all of our content, we are going to leave those to the end, and if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. Okay, here are the results.
Excuse me. Yeah, so, looks like there's kind of a mixed bag on, those who did and did not experience possibly some qualified scenarios with retention credit. So if you haven't taken a look at it yet, it might be some opportunity. So now we're going to transition quickly into the Work Opportunity Tax Credit Program, which is also referred to as the WOTC. Essentially, this is an incentive for employers to hire individuals at a disadvantage for employment. So really targeting individuals who might be on government assistance and help them get back into the workforce and off of that assistance and become more self-sufficient. To the right, you'll see this is kind of a simplified list. These are all the different targeted groups that individuals can qualify under for the business. And then you'll notice there is a maximum credit listed. This is a wage-based credit that's calculated based on the wages that they are paid during their first 12 months of employment, or in one target group, it's first 24 months. So this is the maximum amount that they could generate for the business. The program, it's a federal income tax credit. It's also a general business credit that allows for 1-year carryback and 20-year carry forward. And the program's been around for a long time, and it was recently extended through 2025 under the Appropriations Act. It is a prospective program, so it's not something that you can go back and request a credit on. It's something that has to be a part of a go-forward process with applicants for your business. There is a 28-day filing window for applications. So again, it's one of those programs where you have to be proactive and timely in order to be eligible for the credit. It's administered at the state level by WOTC coordinators. So even though it's a federal program, the state WOTC coordinators are the entity that verify and certify that that new hires have in fact met the requirements under these different targeted groups. And they will issue a certification to allow an employer to calculate the credit on those individuals' wages for the tax year. And then, because it's a prospective program, it's constantly rolling. So as you've got applicants coming into your business, you're constantly, screening them to determine if they qualify and filing their applications. And so the credit is a one-time credit per employee, but you continue to generate credit as you continue to hire, you have turnover, and you are continuing to expand your employee headcount. So as I mentioned, the credit, it's based on, the first 12 months of employment, or in one target group situation, it can be based on the first 24 months. And it's, there's a percent that's calculated depending on the number of hours that they work. So you can kind of see here on the screen, minimum of 120 hours is required for the new hire to work in order to be allowed to calculate a credit on their wages. And then based on the hours that they work, it's either a 25% calculation or 40% calculation. And just, kind of the current data point for construction businesses, specifically non-union employees, based on what we're seeing, I mean, this is exclusive to what we see. This could potentially vary across consultants, but what we're currently seeing, about 7 to 9% qualification, and average credits around 2,500. And, this is because of the types of target groups, but because of COVID and because of so many individuals going on unemployment benefits, qualification rates have increased in the last handful of months as businesses are trying to recover and hiring more individuals. The best way to take advantage of this program is to outsource it. It can be administratively burdensome, and so outsourcing it to another provider is really the best way to optimize it. We've outlined here kind of an example of what an employer typically has to do versus what your outside provider would do for you. This is looking at it from Moss Adams' perspective. This is not the way that all outside providers do this, but just to kind of give you an idea of how outsourcing it can take away a lot of the administrative pieces that without a provider, your HR or hiring managers would be responsible for. And it looks like we have reached our next polling question.
All right, so our third polling question is your company currently taking advantage of the WOTC? And A, yes, B, no, C, no, but we would like to, D, not sure, or E, and A. And MaryCaitlin, while everyone responds, I thought I'd ask you some questions that came in. This one hopefully is an easy one. Is there a deadline to request a refund for the ERTC?
The only deadline that really applies is with amending and the statute of limitations to amend. So you have 3 years essentially from when you filed your original payroll tax return to request the refund. So if you aren't able to file it timely on your current quarter 941, you can amend up to 3 years.
Okay, and here are the results to the polling question.
Yeah, so again, kind of a mixed response. It looks like majority are not taking advantage of it. If you're not and you think that you are hiring candidates that could fall into some of those targeted groups, definitely something to take into consideration. And now I'm going to pass it off to Kyle.
Yeah, thanks, MaryCaitlin, and hello, everyone. So the next incentive I'm going to discuss is Section 179D, which is actually a deduction, not a credit, but it can be a lucrative tax deduction for the group on this webcast. So on December 28, 2020, Section 179D was made a permanent part of the tax code in a couple of the acts that were mentioned earlier, or in one of the acts that was mentioned earlier, the Consolidated Appropriations Act of 2021. The deduction is available for newly constructed commercial buildings or building improvements. And now, because Section 179D is permanent, it's for any improvements that were placed in service after January 1st, 2006. And really, the permanency is a key piece here because it really provides that opportunity for ongoing tax benefits and allows companies to plan for this deduction and ultimately claim it. The deduction is $1.80 per square foot up to that amount of building area. And so with this deduction, both building owners and designers can actually claim the deduction. So more specifically, the categories would be owners and tenants of commercial buildings, owners of 4-story or greater residential buildings, and of course, in those cases, they would have had to have built or installed the improvements, essentially incurred the expense themselves. Specific to this webcast, though, is that third piece, and that's for the designers, architects, engineers, construction companies. They can also claim the deduction, but they must have designed government-owned energy-efficient buildings in order to get Section 179D. That's going to put us into our next polling question.
Okay, so our last question is, has your company claimed the 179D energy efficient building deduction as a designer of government-owned buildings? A, yes. B, no. C, no, we aren't involved in any government-owned construction projects. D, what's 179D? Or E and A. And for those of you that would like a copy of today's slides, you can download them now from the folder that says Slide Deck and Handouts. And we will also be sending the slides via email tomorrow, along with a recording of the webcast. Okay, we'll leave this up here for a few more seconds. All right, here you go.
Yeah, so kind of a good mix, and I'm pleasantly surprised to see D as low as it is with 4.6%. So it looks like quite a few of you folks are familiar with 179D, and so that's a good thing. And hopefully I can shed a little bit more light on what it is and how you can claim it as a designer. So the deduction can be, as I mentioned, up to $1.80 per square foot for energy efficient improvements on commercial buildings, and these energy efficient improvements would have to be above certain thresholds set by ASHRAE for 3 distinct categories. So it's HVAC systems, lighting projects, and building envelopes. And you can also kind of parcel out the deduction as well. So let's say that you just had a lighting project that you designed, or as an owner that you paid for, you could look at just that piece on its own as the 60 cents per square foot. And then also a contractor or professional engineer licensed in the state where the building is located must model the energy performance of the building, and as I mentioned, compare it to those standards set in ASHRAE. So the benefits, of course, are straightforward to calculate. you know, 100,000 square foot building, the deduction, if you qualify for all three components of it, would be $180,000. Or as I mentioned, if you had a lighting project, you could do 60 cents per square foot. And so that, you know, in that 100,000 square foot building example, the deduction would be $60,000. And then you also want to take into account state tax conformity when calculating the 179D benefits, as this isn't just a federal deduction. Some states conform to 179D. So, for example, Oregon, where I'm from, they conform to it, whereas California does not. And then, you know, lastly, another benefit of 179D is that we're just continually innovating with regards to energy efficient design. According to the Department of Energy, both privately owned and publicly owned commercial real estate totals around 93 billion square feet, but it also consumes about 35% of the electricity in the U.S. So really, Section 179D is one mechanism that the federal government's using to incentivize designers or owners and tenants to help lower the amount of energy usage within commercial real estate. So for this webcast, you know, with the property types, the main focus should be on the right side of the slide. So if your company is currently designing any buildings above 25,000 square feet or so, and it's listed on the right side of the slide, or if you've designed any of these buildings within the last couple of years, your company should definitely look into Section 179D. And again, because the deduction is tied to the square footage of the building, the larger the building, the greater the deduction. You know, on the left side with owners or tenants in commercial buildings, the property types listed on the left side, on the left side of the slide, those would provide kind of the most bang for your buck. I'm just going to leave this up for a few more seconds here. So the process for claiming the deduction as an owner or tenant, it's actually fairly similar to claiming it as a designer. So I'm going to start with the owners and tenants. You know, again, you would have to have paid for the specific improvements. You know, again, you would have to hire a qualified third party to model the energy performance. And that qualified third party, the licensed contractor or professional engineer, they have to be licensed in the state where the building is physically located. And then, you know, also to claim the deduction as an owner or tenant, you would just lower the tax basis in the overall or of the overall building. So if you got a $10 million building and the deduction is $100,000, your tax basis is now $9.9 million. You can also go back in time as an owner or tenant to claim the deduction, and you would just do that through a Form 3115 automatic accounting method change. You know, so for a designer, you know, the key piece here is to determine if you're considered a primary designer of the government-owned property or the government-owned building. And also the taxpayer must also receive a signed letter from the government entity that allocates the deduction to that specific designer. And then to claim the deduction on the tax return as a designer, it gets reported as other expenses on the tax return. You can also go back and claim the deduction, you know, back in time. As a designer, it's a little bit more burdensome than as an owner or tenant, because you would have to go back and actually amend open tax years. So depending on the tax structure of your architecture, engineering, or construction company, it might be worthwhile to look back a few years and see if amending might be an avenue worth pursuing. So one of the most important aspects of claiming the deduction as a designer is making sure that you're in fact considered a primary designer of the government-owned building. So for architects and possibly engineers, this should be fairly straightforward. But for construction companies, it's not as cut and dried. Construction companies will want to carefully determine if they're contractually obligated to have design responsibilities for the building. So if you were in a design build situation, you know, that's more likely to qualify for 179D than if you're just, you know, simply installing the improvements. The allocation letters, as I mentioned earlier, these are documents that state that the building meets the Section 179D's energy and power cost requirements, and it's signed by both the designer themselves and then also someone within the government entity that has that authority to do so. The government entity can actually allocate the entirety of the deduction to one designer, or they can allocate it amongst multiple designers. You know, so they could elect to allocate it to the architecture firm, the engineering firm, and the contractor, if the contractor, of course, is deemed a designer of the building. So they can split the deduction kind of at their own discretion. And this allocation letter must be signed by someone within the government entity, as I mentioned, that has that authority to do so. So you'd be looking at somebody that's a CFO type, a city manager, somebody like that. The government entities can allocate the deduction, as I mentioned, to one or multiple designers. And so, the earlier you get that allocation letter with the government, the greater likelihood that you're going to receive that full deduction. And also, just from a timing perspective, because you'd have to go back and amend prior year tax returns to claim a prior year deduction, it's important to start that process as soon as you can. So for designers that have not yet filed 2020 returns, it would be important to look at that now for 2020 projects, and then also for ongoing projects in 2021 or 2022 that are currently under design. And lastly, just a couple of kind of common questions that we get. So, will claiming the 179D deduction as a designer trigger an IRS audit? The answer to this is no. It's not going to automatically trigger an audit, but it's definitely important to ensure the proper steps have been followed to determine the qualification for the deduction. Like with any other piece of the U.S. tax code, it's important that you do your due diligence on any tax incentive that you may be taking advantage of. It is included, Section 179D is included in the IRS's LB&I practice units, which has actually been kind of a good thing for the 179D industry because it just provides a framework for designers that might be eligible to claim the deduction, and kind of, shows the designers what the IRS is looking for when they're, potentially auditing these. Second question we get often as well is, hey, I designed a building for a non-for-profit organization. You can't claim 179D as a designer in that situation because it would have to have been owned by a government entity. And then lastly is probably the most common question that we get, whether it's for owners, tenants, or designers is, we designed a building that's LEED Platinum, can we just take 179D, to take the full $1.80 per square foot deduction? And unfortunately, no, you cannot, because LEED has no bearing on your ability to claim the deduction, as the criteria is it's just different. And so you would still need to hire a qualified third party to conduct the energy modeling, and then, of course, to sign off on the deduction. But, of course, if you design a LEED Platinum building or LEED Gold or Silver building, it definitely doesn't hurt. So I think we may have time for one or two quick questions. I'll kick it back to
all right.
Shane.
Yeah, we have time to probably squeeze one question in here. This one is geared towards Shane, and it is, our company has common ownership with our affiliated companies. How does this work when claiming the R&D credit? Do we need to calculate the R&D credit for each affiliated company that has common ownership to determine the eligible credit?
Yeah, that's a good question. So depending on, the ownership structure, percentage, if they're individuals or corporations, but there can be a situation where it forms basically what's called a controlled group. And the way the calculation works then is you still go through and you identify the R&D expenses that are generated by each entity or company, but then you pool them all together and calculate basically a credit at the group level. And then the credit is then broken back out to each entity based on the percentage of R&D expenses each contributed. So they all need to be taken into consideration, I guess, and everything kind of gets lumped together, but then it's broken back out to each kind of company or each entity individually.
All right, thank you. And I do want to be mindful of everyone's time, so we do need to skip the other Q&A that came through, unfortunately, but we will do our best to follow up with you to get you your answers after the webcast. And thank you, Shane, MaryCaitlin, and Kyle for a great presentation today. And thank you to our audience for your participation. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. And if you participated as an individual and met all requirements, your certificate is available to download now in the CPE progress window. And we'll keep the console open for a few minutes to give you time to download. And a copy will be emailed within 3 weeks should you have difficulty downloading it now. And here is a link to an online survey for today's presentation. Please take a moment to complete the survey as your feedback is very important to us. Thank you for joining our webcast. We hope you'll join us again next time.